Someone from your fan club sent me this shirt. I don't advertise.
I love that.
This is really cool. Have you
How
seen
is the-
this
is
saying?
it-
Have you seen this saying before?
Well, is it multiply cotton? How would you say the quality of the t-shirt is?
I have a rash. It's been on for 2 months. And the rash is stretching down to my neck. And it's
Why?
like 3 minutes. And my toes are itchy. So I don't even know who sent me this and what they put on it. So we're both Canadian. Secret handshake. I don't even know what that is. So when did you leave Canada quickly?
I left in 2000. Been in America now for 20 years.
And were you being chased at the time, or you left on your own?
I came. I mean, I'd probably be chased now if I tried to come here, but I came on a TN visa. One of the NAFTA visas for engineers, and I came as an electrical engineer.
And how old were you?
Oh my gosh. Well, I'm 44 now, so I guess I would have been 22.
So you're 22, so I'm 55. Okay, so we're 11 years apart. And you went to Waterloo?
I did electrical engineering.
And then I'm going to go right to today because I think, StockTwits adores you. I think there's two people that StockTwits adores, not me. They adore being left alone, which is what I think is cool, right? Twitter people don't want ads. They want to be left alone too, right? Twitter is the Bloomberg, StockTwits is a mini Bloomberg, Discord, Telegram, everything, right? There's no inside information anymore, right? It's open the internet and go to work. The StockTwits has gone bananas for two people. Dave Portnoy, who I think has already dropped the ball and just given up. And maybe he should have, but I thought it could have been something great. And then you. And I wouldn't have predicted either. Obviously in 2020, I wouldn't have predicted half the things or anything that happened. So what is it about SPACs that caught the imagination of retail and institution? What do you think?
I mean, I think you're taking high velocity growth businesses that, have 10x or 100x potential, and you're unlocking them to average, normal, everyday folks. And I think that's really powerful. You're getting these companies at the early part of their growth cycle, and you get to participate, and you get to be. And the SPAC is interesting because it does it in a way where you're effectively side by side with the sponsor, and you get the same economic participation as they do in many ways. So I think it's basically you're front running, and you're displacing a bunch of very blue chip hedge funds and family offices and endowments that typically get the call. And I love that about it. I think getting it into the hands of just normal everyday folks is pretty cool.
But SPACs have been around. Noreen, who's doing the stuff at Credit Suisse, is a legend, supposedly. You've been doing it before anybody was doing. And I know a lot of people in the space who come from Canada. You were born with a SPAC. Your cousins get a SPAC. Your bar mitzvah, you get a SPAC. I don't know what you do for when you turn 13, but you got a SPAC even if you're not Jewish. So what is it about 2020? Because SPACs, what is it about? I say it's a combination of things, and I say, well, it's, if SoftBank can lose 300 million, I can lose 300 million. I said it was a combination of T. Rowe Price, Fidelity, SoftBank not doing their job. They had the opportunity, they had the mantle. You can't write $300 million checks in an Uber and think that's cool. And that was the top for many things, and then the beginning of this new thing, which is SPACs. Is that part of it, or is there anything that set it off in your head?
I mean, to be honest, I think it was the deal that I did with Virgin that really set the whole thing afire. But underneath it, I think it's because people were and are in general, actually, and this is the art for most people who are willing to take the time, it's laziness. Just this idea that you aren't willing to think from first principles, and you hear a SPAC and you just go to the accumulated orthodoxy of how people have viewed it in the past, without actually looking under the hood. How does it work? Why did those deals turn out the way they did? Are those deals actually good deals? Would I have invested in myself? What were the flow of funds? How did the economics work? Nobody was asking those questions. And so, my partners and I took a pretty big shot in terms of trying to prove something. It took us 2 years. We went right to the, sort of a few seconds left on the shot clock to get the first.
Zach closed on Virgin. So you had the shell, and it took that long to get.
Well, I actually I've come close. So I've done 3 deals, but what I tell people is I've actually done 6 deals, but 3 never made it. And
so they didn't de-SPAC. They didn't de-SPAC.
No. Meaning like, we aborted the process.
Oh, okay.
And so you can imagine the accumulated knowledge of, coming so close to writing in these cases. So in these 3 SPACs, we've written $450 odd million of our own capital. That's a gut-wrenching process, Howard. Like I wake up with, and it feels like I'm back in Sri Lanka. Like I'm like running to the bathroom with dysentery because it's like, oh shit, like this is a big check and I'm nervous. So
this episode is presented by Masterworks. My wife Ellen and I are longtime contemporary art fans, having collected contemporary art for 20 years now. So I was thrilled to have Scott Lynn, the founder of Masterworks, on the podcast to explain the fascinating art world and how exactly this industry operates. The art market allows us to think about diversification and fractional ownership in such a unique way. This is an amazing industry that remains uncorrelated to other investing classes. Every investor will enjoy listening to this episode, I promise. Head over to howardlindzon.com/masterworks to give it a listen. The link is also in the description of the video.
You can imagine the first deal had to be perfect. Literally had to be perfect because not only had it had to capture consumer interest, capture retail interest, capture buy-side interest, but it also had to reverse all of the accumulated, misunderstandings and hatred for SPACs.
Yeah.
And, when I met Richard Branson for the first time, I was like, this is the vessel. This is the company. He's
been around. He kind of he probably was open-minded.
I've never met anybody like this guy in my life. He is the closest thing to a rock star. He is more famous than most rock stars. You walk around the street, and by the way, this guy is so humble and down to earth. Yeah. He has no security. Yeah. He just kind of like, it's just him. And
did you see him on the island or in London? I went to the island and met him. Where'd you see him?
We spent a lot of time together in New York and on the West Coast. Funny story, by the way, when we were supposed to fly out there for one of our first board meetings, it was 1 or 2 days before we all went to shelter in place. So I canceled the board meeting as the chairman. Mm-hmm. And I was like, I'm sorry, we're not flying out there because there's a risk that, Trump may not allow us to fly back into the country. And nobody wanted to get stranded on Necker. Now, it turned out that you would have wanted to get stranded on Necker knowing what, how much of a shit show it was here. But just to finish the story, Howard, he would walk around New York and the number of people that would approach him with all these different stories related to all of the different companies he had been a part of. So he was just a special individual. And, on top of that, he had poured $1 billion plus of his own money into Virgin, and the business model was so exciting. So, it's a combination of some timing and frankly, a lot of luck. And, to have somebody like him being a mechanism that actually proved the business case. And now, we got 3 under the belt and trying to do 3 more. And
yeah, mine are named after Batman villains, my SPACs. So I'm debating if the first one's the Riddler or the Joker. So you may give me some free advice here. So since the first SPAC, since the first one. So what is the process that's changed the most? Like, obviously you're learning, I'm learning, StockTwits people are learning, they're being laughed at, right? Well, I know it must bug you because that's on you too. Like when we get laughed at, when the retail gets laughed at, in a way you're getting laughed at because you want the retail to win. And
I really, the only people
that's why I think they like you, and that's why I like you, but because I don't know you, but I like you because you're just, and you're even making CNBC, which I don't watch, giving you time. Like they're making, someone who building StockTwits couldn't get the time of day from these people, and that's fine. That's how media works, right? To see you get the time, I'm not jealous. I'm just like, okay, finally, someone is getting the mic without being interrupted, and it's still they're trying to interrupt and whatever. And it's almost unwatchable. It's still, but at least they're giving you the mic. And the retail people, they can't listen to their own eyes. They want to hear this all day. They want to hear this all day.
I care about 2 constituents. One is myself, and then 2 is retail. I was a pretty traditional capital allocator after I left Facebook. So for 8 years of my life, I was a typical LP-GP structure. And when I returned the capital, it was the most liberating thing I'd ever done.
It's great. Yeah.
Because then I was responsible for myself, because I never got some, tremendous joy in running at the time there was a a budget and 30 fund, which is pretty good. But it didn't float my boat. And, there were some really great LPs that I worked with, like Mayo Clinic and, Soros and folks like that. And then there were some just total dirtbag, scum-sucking fuckballs who I just really was like, I can't believe I work for these people, because they're just kind of
they panic and they behave just like they accuse retail of. They're worse.
Trash. Yeah. And so the problem for me was, when the quantum of capital became big enough, I would focus on the 1 or 2% of the people that were just bad seeds, because they would make all of the noise. And so I said, enough's enough. But now what I can do is I can just be by myself, but through SPACs as an example, other folks can basically be beside me. And that's pretty cool. And you're right, like I get laughed at a lot. I don't think that the traditional investment community likes some of the ways in which I think about things. They laughed me off the stage when I was on Irisone, Lincoln Center, in front of 5,000 people, and I picked Amazon in 15. I was literally laughed off the stage, and the 3 or 4 people after me were making fun of me, guys that I know. David Einhorn made fun of me. It was just like, I was like, okay. And then when I did Tesla in 16, it was the same situation. And, look, I simplify what is a very complicated underwriting process to basically give you a one-pager or, really simple slides with a few words. But the reason is because I think, like, if you can't explain it to your son or you can't explain it to your mom, then you're making it too complicated. And if you can't write an investment thesis on one page, you shouldn't be buying something. You don't understand it, in my opinion. And I think it really tweaks sort of the establishment when I do those things. When I pitched Open Door in 4 minutes or Clover in 5 minutes, you can see steam coming out of the ears of folks because they don't like it. Whereas, an average everyday person can actually understand a business in 4 or 5 minutes if you actually present it that way. So, I think CNBC, it's kind of a necessary evil at some level. Yeah. And so, what I'm trying to do is proselytize. And, ideally, I think that the real escape velocity for me would be to figure out a way to be more part of a StockTwits community or, Wall Street Bets or whatever it is, where I can have a YouTube presence or Discord or whatever. I haven't figured any of this out yet, but I think like being more connected to retail where we can have a community and I can be a part of that. And I think that would be the best outcome.
It feels like we're kind of like brothers at that level, in the sense that you asked me at the beginning, it's like, oh, StockTwits should be bigger, or you thought that it, can be bigger. And I explained to you before we went recording is that, I don't know, it's like, it's very hard. I think what I'm proud about at StockTwits is, having 500,000 people yell all day in a semi-organized way. It's not for everybody, but I see the CEOs of public companies hit me up and go, you got to get rid of this. I laugh when like Bain will call me up or something, this guy's crazy, or Matthew from, another public company. And I'll say, guys, it's just sentiment. Like, just take it all in. It's a fire hose. It's not perfect. You can't in real time curate. Like, that was Twitter. Twitter had a lot of room to maneuver because you got to give them a lot of room, because there's 1 million people talking at once or 10 million talking. You can't curate. You can't police that in real time, but you can set the tone, is what StockTwits has done, and said, listen, if it's funny and if you're on point, everybody screws. So it's the trading floor, but you've got to have some kind of decorum around this, even at the retail level. And I think that's what we focus on. And that's not a VC business. So my mistake maybe was that just takes time. Like, now we grow organically with 3,000 or 4,000 people a day, and you can't just misbehave. You will misbehave. Obviously, people will misbehave. It's retail, but they're not going to get away with it for long. And I think when you set that, that's why we're growing faster than ever. And then the other thing that makes StockTwits unique is, who would have predicted it was SPACs? Like, I'm happy that Space and DraftKings and IPOB are in 2008 with SPAS, triple leverage negative fintech ETF. That was the #1 ticker. Today it's Space and Jinx Solar, and there's so much sentiment and data in what the retail people are doing. So it doesn't bug me anymore when people do this. Obviously it doesn't bug you, but the retail people have been, the young millennials are the ones that are going to take all this capital that the old people are sticking with us, and we need to get smarter about this. So SPACs can, do you think we're in the early innings of this?
I think we're like in like the top of the first. I think that it's first of all, the governing logic of how to go public is pretty broken.
Yeah.
I think that, the traditional IPO model is pretty busted especially for a high growth tech business for really, there's a bunch of mechanical things that are wrong, like the way the pricing is done. But I think the most important thing actually for an entrepreneur and, for you and I on the buy side of an IPO is in a traditional IPO, you can't show a forecast and you can't talk about the future of how you want to do things.
Okay.
And you're just not allowed.
Yeah.
And that one thing is so problematic. And it's what causes a lot of these, mispricings in a bunch of these companies. Because look, in a tech business, the past is the least indicative of the future because, these smart entrepreneurs are pivoting and they're shifting and they're iterating, they're testing. And so pinning somebody from what happened 18 months ago or 24 months ago in a business where, you're turning the business over every year makes no sense.
Yeah.
And so just at a minimum, the traditional IPO is kind of, I think, broken for tech businesses. I think they're fine for traditional cash flow businesses that are highly predictive because of the past.
Mm-hmm.
But for tech companies, it doesn't work. And then it's also pretty terrible for concept bets. So if you look at biotech, biotech is a huge opportunity in the future now too, because if you ask me, Howard, Chamath, where could you make a shit ton of money in the future? Mm-hmm. Number one is understand technology. Number two is understand biotech. Now, biotech is much harder, but why those two? Because most of the innovations in technology now sit on top of three fundamental things that didn't exist 10 years ago, or really 15 years ago. AWS, and then, all of its copycats, mm-hmm. iOS and Android. Those are the only three things that really matter. And with that, you have every single great company, whether it's Snowflake to Twilio to Facebook to Instagram to TikTok, all sit on top of these three abstractions, right? So it created an ecosystem that is just enormous, measured in the trillions of dollars. Mm-hmm. Well, if you wind the clock back, biotech is actually at the same part of the curve now. You have delivery things like CAR-T, you have implementation mechanisms like CRISPR. That's biotech's version of iOS, Android, AWS. So my point is,
that's cool.
If you had to figure out 2 or 3 areas that are just going to skew positively and generate huge alpha, mm-hmm. those are 2. Now, those are 2 obvious areas that are not well suited for traditional buy side, for traditional backwards-based forecasting. And so the setup is amazingly good for retail because you are going to run circles around institutional capital. So think about this. If you're running a hedge fund, you run a 2 and 20 business, your overwhelming compensation is from the 2%, not from the 20. Mm-hmm. And so you're managing skew, right? Yeah, you're managing volatility. You're managing for, don't fucking surprise me. I don't want any surprises, I want slight meet and beat. And so all of that is a backward looking understanding of the future. Now, tech businesses are not that. Biotech is not that. Both of these 2 things have huge asymmetric, positive skew. And so there'll always be discontinuities. And so if you can have, for example, if you look in Tesla, Howard, I don't know if you spend time in the Tesla community and Twitter, they're the smartest people. Yeah. And, you look at the battery guys, the physicists, the material science people, they work in a community. You get to ground truth on Tesla. I got to ground truth on Tesla in 2016 from those folks.
Mm-hmm. Me too. And I think with Tesla, my big mistake on Tesla is not buying the car. My big win in Apple over the years was just owning the iPod and going into the store early. And just by being in the store, I won, because I knew something that nobody do. By going to the health club and seeing the earbuds, I won. I think the lesson of Tesla to me was, why the fuck didn't I buy a car? My partner, Gary, who's ridden the stock for forever, just owned from the first Spider car to this car, is just own the car. And that was my mistake. So biotech will be harder because people don't fully understand. That may mean the opportunity is bigger. So I think that's interesting that you bring it up, because the average retail person, someone who I'm only as good as my last idea, because I got to be careful with what I share with the community. When I talk biotech, I talk BIB and IBB, saying, unfortunately, you got to own the basket. It's very hard to pick biotech stocks. Like it's the one
Well,
area where
it turns out that if you were part of every biotech IPO allocation, just to put $1 in every IPO since 2012, you would have generated a 23% IRR. But if you had picked the top decile of outcomes, you would have had about an 80% IRR. So, there's a huge bias here to doing it right. And I think it is like tech stocks. But I think both of them, the solution is the same. So I do think that there's a combination in the future of three things that I think are like the future of financial investing, even for folks on FinTwit. I think the individual names are good purely for concentration, but I think the three meat and potatoes positions are SPACs, ETFs, and BDCs. I think that you're going to actually see a complete renaissance in BDCs as well.
And so BDCs quickly.
Basically, a BDC is a, like, for example, people ask me all the time, Chamath, would you take social capital public? Well, the simplest way to take social capital public would be through a BDC. And it essentially allows me to have an investment manager, meaning me and my balance sheet, and where you can own basically an allocation of everything that I do. Now, the BDC has some arcane rules, like if you generate investment income, if you don't reinvest it, you have to distribute it. There's all kinds of rules like that. But much like the SPAC, I do think that somebody, maybe it'll be me or somebody else, will poke on this BDC thing and figure out how to basically build a modern Berkshire as a BDC. I do think that, if you look at Cathie Wood and ARK Invest, that's a really interesting canary in a coal mine. I don't think it's yet scaled how ETFs can actually be really purposeful. Mm-hmm. So I think in my opinion, like if you take a 60-40, kind of the orthodoxy of 60-40, throw it out the window. And instead, I think what you need to say is you're long growth in a world of zero rates. That's, sort of the basic sort of like, part of the thesis.
Yep.
And then I think what you do is you say, well, you want to own, some sort of like tech stuff. You want to own some biotech stuff. You want to own some, climate stuff. And you express that view in a portfolio construction with a combination of SPACs, ETFs, BDCs. And then when you get super comfortable with a name, that's when you basically say, okay, now I'm just going to get hyper concentrated in, such and such a company because I so understand it.
Yeah.
But I think that people will look back, and when you backtest this in 30 years, that will have been the most compelling way to generate like 20 to 30% yearly, returns.
Yeah, I call it the great unwinding, right? Obviously, Ben Thompson talks about aggregation, disaggregation. I think we're at this great period. There's always this argument in StockTwits and the FinTwit, active versus passive. I mean, the S&P 500 is an active momentum product, right? Just cap weighted. What happened is, in my opinion, American kids should not own 500 stocks. What the fuck is the point of owning everything on the shelf?
Well, I don't even know how you can own 15.
Right. So Americans are over diversified, which I've been saying forever. If you want to get rich, find smart people, read, become an expert in one thing, and take risk.
Or honestly, like, look, you can pay other people to diversify smartly for you. Meaning, if you look at Cathie Wood, ARK Invest has a great platform where there's a team of thoughtful people. I'm not going to make a judgment on their diversification, but the point is, to pay 76 basis points a year for her diversification, where then you can cherry pick the best ideas and get concentrated and really learn about them. That seems to be a much better strategy than you finding 50 companies to own.
Absolutely. And so I've been for the last 10 years QQQ over SPY, and now Invesco's getting smart and they're creating, the up and comer QQQ, et cetera, et cetera. So product's coming. It's slow. And they could have.
By the way, my massive levered ETF bet this year is long. No, it was long the weighted S&P index, short the unweighted index and lever it 10 to 1. And so, if you had $1 billion, you could put $10 billion of this on, 15 billion. Frankly, you could have really run the table. You could have put 20 billion of it on. The prime brokers would give you huge turns of leverage on this. And basically, it did 12%, where, when you're long the weighted, you were up 8 or 9%. And when you're short the unweighted, you're basically shorting everything that's not FANG. And that would have made almost 180 basis points. So the whole thing was 10, 11% multiplied, times 10 turns of leverage. It was a bonkers trade.
And so what surprised you the most? I got a few more. I know you got to go. What surprised you the most since March? Outside of you running your business, what has surprised
I
you the
think
most
that
about
I didn't.
America and COVID and everything where we are today in October? What surprised you the most?
The level of intermingling between fiscal and monetary policy, I've never seen that before. I think that we won't really know what that hangover feels like for another decade. It probably is well, at least we know at least until 2023, you can be long equities basically with your eyes closed.
Isn't it amazing? People don't understand this. They're like,
Yeah.
they don't understand how powerful this stuff is.
I mean, just for your viewers, like, as you know, but just maybe just to summarize, like, the Fed basically said we're going to keep rates at zero until 2023.
Yeah.
And so what that basically means is that you can be effectively long, and for some people, if they know how to manage the risk, levered long equities, because you'll always have a bid. If rates are at zero, you have you have a massive asset class, i.e. fixed income, that's worthless.
Yeah.
And if you're talking about meeting pension liabilities at a minimum, you have a huge bid. If you talk about the 401ks that exist in the United States, what is that? The two things together are probably $60 trillion of buying power that has to get put to work.
Yeah.
What do they do when you take, half that portfolio and put it to zero?
Yeah. It's very hard for someone like me who understands how things works to have the game politicized and changed. So I'm not complaining about it. I just live within my own risk profile. Meaning I have way too much cash. I'm Canadian. I'm like old. I have man boobs. I'm wearing a Chamath shirt. I mean, things are over. I'm like, this could be my last Zoom call at this pace. The thing is, people have to live within their risk means. They still have to. And this is why I'm so bullish on Robinhood and eToro. And I know you know both companies, and you understand eToro because of Facebook. It's an incredible. Have you met anybody there and understand how interesting that company is?
I think it's really the future, because I think what eToro is proving to people is the value of social communities, and that there are these incredibly powerful ways by being able to follow and mimic and copy portfolios where you can draft off the best people. Now, the one thing I'll say is that eToro will have the same problem as everybody else does, which is, how do you actually do the dynamic portfolio management for people? Because again, whether you buy a stock that you don't follow or whether you copy a portfolio manager you don't follow, the problem is the same, which is that, you end up with 24 hours in a day, and, you're one kid's got a cold and the other kid wants to go to school, and, your partner's screaming at you. So, what the fuck do? You stop paying attention. And so, I really think, Howard, like the future is all roads lead to passive active management, meaning the passive part is you find a few brands you trust, and those people are actively sweating it, and they have so much of their own skin in the game that really what they're doing is they're managing their own PA, and you live and die by them. Mm-hmm. And that they are then front and center in a way where you have a relationship with them and you can understand it. So, you mentioned Kramer before, like, where is the modern Mad Money? Where is the modern sort of Squawk? We don't have any of those things.
That's on me. Part of it is on me because I do it with this show, and I do it. I'm not a master at playing the game. I'm a master at loving the game, right? Kramer loves the game. You love the game. People on CNBC love the game. It's just the world's changed. It's not TikTok. It's not Snapchat. It is Squawk Box. The world needs a Squawk Box. The world needs video communication. The world needs some lean back financial discussion. Kids are not dumb though, man. They're jujitsuing it from TikTok to Snapchat to Telegram to StockTwits to WhatsApp. You can't put it in a box, right? This is why the disruption, the Goldmans and the JP Morgans, they may just start accelerating to the downside. It's not one thing. It's just it's over. Like, the brain drain is all that's left, or the businesses that no one really cares about anymore. So
by the way, let's just state the obvious, as you mentioned some of these names. Banks are so fucked.
So fucked. People go, I'm going to short Tesla. I go, why don't you short the banks? Like, you may take a 20% risk, but they're going to zero.
Stupid. I had a tweet I put out there, ha, 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 Tesla Q. I love it. Those dummies have lost so much money. How many times do you have to get your face ripped off to realize you're just an idiot? Go short a bank. Well, rates are at zero. Rates are at zero. Like, you need an easier short?
Yeah, it's an obvious trade, and they've been, mean, they're the ones that are actually the most being buoyed so far because they're being helped the most. They're the crippled, crippled children. The thing about Tesla is the other thing people don't understand about this imbalance is global. So we wake up in the morning, no one understands that with Drive Wealth and Alpaca and Apex, that there's 1,000 Robinhoods being born, I tell people. So when we wake up at night and Tesla is down, that may be a discount to someone in Nigeria or Eastern Asia or China who's using their app to buy fractional ownership of Tesla. And the next morning you wake up, it's limit up, and you go, what happened? I'm going, well, the rest of the world bought the dip.
And there's another thing there, which is that there is an insatiable demand, whether we want to acknowledge or not, in U.S. dollars and U.S. dollar denominated assets. I mean, let's go back to that example. If you're sitting in, Togo or Ghana, where the T-bill rate is 15%, what that's really telling you is your currency is worthless.
Yep.
It's Zippo. And so, of course, you'd rather own a share of Tesla in hard U.S. dollars.
Yeah, even if it drops 60%, it's the brand. You'll average down.
Howard, there used to be these buses that drove around Palo Alto, and these big luxury buses. Mm-hmm. And they would stop. I'd be walking the dog. They would stop. And all these mainland Chinese folks would stream out. And, it looked like it was like a tourist, trip to the Vatican or something. The woman had the little flag and she had the mega horn. And it was Chinese folks that would fly here expressly for the purposes of buying real estate. And, what they were doing was washing their Chinese currency into USD. And then China put a currency control in place because so much money was flooding out. So, that I think has supported real estate in at least the Silicon Valley, at least, 15 or 20% of the demand for the last few years. My point in giving that example is, to your point, there are so many countries that, as dysfunctional as America is, are so much more dysfunctional. Don't underestimate the bid that comes from the rest of the world.
Yeah, which is why I also, again, I'm not going to get politics, which is why I don't like our leadership, which is why they could explain this in English to us. They could explain, yes, things are tough, but this is why you buy American companies. You don't have to you don't have to manufacture here. America is, because of the way we live and work and people aspire to be us, that's all a president needs to say. It's the way our markets work. The money's flowing here. And it's like, we're doing everything to undermine that trust and politicizing these things, which is a boon to you and people like me who understand how markets work, but we're just trying to pass that stuff on. How does this spill out quickly into Bitcoin? I know we'll have you back, but how does it spill out into Bitcoin? For me, it's something, you don't have to dive that deep into it, but it's just directionally for me, it's like, it makes so much sense. How do you contain your excitement for something like that, where it's just something with limited?
I've tried to temper it. I do think that I'm going to become a little bit more vocal around my support of it. I was an early owner. I've owned it for a very long time. Mm-hmm. I think my dollar cost average is, I think, $120, mm-hmm. Something like that. My first purchase was at 80. I stopped purchasing at 130.
Okay.
So we're at 13,000 now. I think it's a hedge. I've always viewed it as sort of schmuck insurance against exactly this orthodoxy that you just talked about. Mm-hmm. But I think in other countries, it's more than a hedge. I think it's becoming a principal mechanism of value, storage, and exchange. So I'm going to spend a little bit more time now. So I think I kind of set it and forget it. A bunch of the coins went to a bunch of different companies to basically stand up a bunch of different businesses for them, lending, ETFs, trading, et cetera, because I didn't want to own the coins. Mm-hmm. I just wanted shares because it was easier for me to tax structure shares. Mm-hmm. But I'm going to pay a lot more attention going forward, and I'm going to make this sort of one of these 4 or 5 things that I now become an expert in again. So I've
just been digging in again too, and Brian, my friend Brian Norgard's been digging in further again. A lot of the smartest people I know around product and macro, and people that aren't famous for it that I talk to, are directionally still remain incredibly bullish, as do some of the best macro traders. So it's something that I follow. I got a million questions. We had a hard stop at 3, so I'm going to let you go. Thank you. Do you use StockTwits? Are you? I know you're not leaving comments.
Well, I can't use it. I can't use it per se, because if I step in there and I say something that I don't
Oh,
want to
obviously, but you know what's going on over there.
I stalk it. Yeah.
And so what is the number one thing that you would like to tell people who have a Robinhood account, who have an eToro account, who want to buy a little bit of Bitcoin? How should they think about investing? Like, if there's just...
No, first of all, you are the future. Second, I think more and better and more valuable community is coming through mechanisms like StockTwits and other things. Be open and be kind. There are some really smart people who want to be in this community to help. And, being a dick is just kind of like a short-lived thing. Yeah. And it never works. And every dick I've ever met is poor. Yeah. So, there's a real correlation with wealth and happiness, I think. And there's a correlation for people to want to help. So be intellectually curious and just be kind and just be patient, because I think you guys are going to rule the day. It's basically coming towards you. It's like skating to where the puck is. You guys are where the puck's going to be. So be patient and, be kind and help each other.
Sorry, one last question. That's awesome. One last question. And the Robinhood versus Robo versus, what did the VCs get wrong? Why is there only one Robinhood? There's Lyft to Uber. There's 1,000 delivery companies. What did people get wrong about investing to let Robinhood run the table so early?
Well, I think the future is still very much TBD, because I think that what people need to digest is how Robinhood makes money. They're basically a data broker, no dissimilar to Facebook and to Google, and I'm not sure that people know that yet. So I think a lot of the reason why people didn't invest in it, because it looked like a capital war and there was no product moat. It looked like it was a capital moat. And the problem with the capital moat is that that's the only way in which incumbents can win, because they can themselves, basically, they just have a cheaper cost of capital. And so you've seen, a lot of other companies draft off of this tailwind of free stock trading. And so, I really think the thing for Robinhood is to become more like eToro before eToro becomes like Robinhood. Because the reality...
this way, I've been saying that. It's coming this way. Both sides are coming towards each other.
The reality is that every company is going to have free stock trading, and everyone's going to have fractional ownership. It's whoever nails the community part right is going to win. And nobody's going to be able to sell this data to, a market maker.
Yeah, that's why I own, StockTwits in the middle, and I see eToro on this side and Robinhood on this side, and you can just see it. There's not going to be one that rules them all, but you have to be able to meld it together.
I think if you get community, you can have a winner-take-all outcome. But in the absence of community, it's sort of like a very, the problem is, for example, if Robinhood goes public, the problem they will have is they will get comped to Schwab and, E-Trade and Ameritrade and Scottrade, and, all these folks will publish and or leak their numbers, and you'll see a very difficult LTV to CAC comparison. And so what are you left with to do as an investor? So it's market cap depressive. Now, that's if you're an investor at this valuation. If you're an investor where you are, Howard, you're going to be printing money and you'll be running around Scottsdale in a fucking male thong. So
I don't even have pants on, right? I have a Chamath shirt on and no pants. How are you doing?
That's what I thought. So for everybody
that isn't the world and the bottom at the same time.
Right. So everybody that isn't you that has to buy this thing at $11 billion, that's what they're going to do.
I'm not telling people to buy this. I've disclosed I've sold some at $5 billion and $11 billion. I mean, I haven't sold eToro, but I haven't sold StockTwits.
Well, there you go. You just answered your own question. So
it's just interesting to hear your take on it, because I'm obviously bullish on community. I think Robinhood could use their market cap to buy a ton of companies. This will be a whole nother discussion we have. I've already overtaken the time, so I really appreciate it. Obviously, I hope to have you back on. This show is called Investing for Profit and Joy, which is kind of my tagline. It should be profitable, but you can have a lot of fun doing it. The joy that I see from you and Adam Bain is you guys laugh and you guys are actually rooting for the little guy. and doing the hard work at the ground level. So as a StockTwits person in our community, I appreciate it. I thought you should know that from the top down, and we'll have you on soon again.
Thanks, Howard. Appreciate it. Have a great weekend.
Cheers.
Bye.